Even if you're new to crypto, chances are you've heard the words Solana before. And even if you haven't, that's what we're here for. Named after Solana Beach, a small beach town north of San Diego, where the developers previously lived and surfed together. These kind of coastal vibes are even woven in within the Solana ecosystem brand and colors. The vibrant green, purple, and teal colored S has influenced the design of many builders and creators who choose Solana as the place to build their products. This open source layer 1 blockchain is a well-known entrant into the realm of the Ethereum killer blockchains, bringing them with thousands of transactions per second and extremely cheap transaction fees. Even the NFT space on Solana in terms of sales is second only to Ethereum. Will this new contender step into the ring and land an uppercut on the Ethereum protocol, or collapse under the enormous pressure? Let's begin. First off, we're going to talk about the Solana history. Solana's genesis story began in November of 2017, when founder Anatoly Yankovenko published a white paper describing proof of history, a new technique for blockchain tech that allows timekeeping between computers without the need to trust each other. Why is this important? Anatoly noticed that blockchains like Bitcoin and Ethereum were limited to 13 seconds per transaction, and believed this transaction limitation could be eliminated with an internal clock on the blockchain to help the validators reach agreement faster. He had hopes that blockchain technology could eclipse even Visa transactions of 65,000 transactions per second by incorporating the proof of history protocol. As Anatoly had experience working with the semiconductor giant Qualcomm and storage solutions company Dropbox, his experience in the field allowed him to see that reliable timekeeping makes network synchronization simple, limited only by network capacity. In simple terms, think of proof of history as a clock for the blockchain. Solana is a mix of proof of history and proof of stake. As a refresher, proof of stake validators have to have skin in the game by staking and depositing and holding Solana to verify transactions. Any bad actors or false verifications would cause the validators to lose their staked Solana tokens. Now, back to the story. Anatoly, along with Qualcomm colleagues Greg Fitzgerald and Stephen Eckridge, improved the design using the Rust programming language and using computer graphic processors to increase transactions. The founding team also included former Apple engineers. It was originally named Loom, named after their plans to weave all the world's transactions together on one blockchain. But after another project named Loom came out, they went with Solana. In 2018, they demonstrated that 10,000 signed transactions could be verified and processed in just over half a second, and could be improved upon even further by offloading verification to graphic processors. In 2019, they had a test net and that reported 250,000 transactions per second. Between this time, they raised over $20 million in private token sales and raised another $1.76 million in token sales before their mainnet launch in March of 2020. It was in 2021 that Solana had its explosion in price. Now let's talk about the price history. In 2021, Solana had its breakout year, and it ran from $1.50 all the way to its all-time high, just shy of $260. That's an incredible 173x. Its all-time high also touched the $77 billion market cap, eclipsing even the market caps of Mercedes-Benz and LG Electronics. Now let's talk about Solana Pay. MasterCard, Visa, Shopify, Solana? Another interesting development in the Solana ecosystem is known as Solana Pay. Many crypto companies pitch their coin as being the new money that everyone will use. But outside of Bitcoin, none have really caught on. And even Bitcoin has not met mainstream usage in full form. Solana has recently tossed their hat into the ring of the trillion-dollar payments industry. Solana Pay will leverage Solana's fast technology and thousands of transactions per second, dedicated development team, and connections in the Silicon Valley to make that as possible in the near future. Their goal is to create a payment system between the merchant and the customer, eliminating the sticky fingers of the middlemen and platforms that stand between them. And processing transactions is only the base layer of their multi-layered cake. Here's where things get really interesting. Since Solana already runs successful NFT transactions, creating an NFT experience for the customer's experience is a logical next step. For example, suppose you go to one of those fancy bakeries and pick up a cake for your friend's birthday. The type of special cake that you can't tell if it's a cake or not. Must be a pretty good friend, right? You make the payment almost instantly, smooth. Then when walking out of the cake shop, you get an NFT that you can show off long after the cake has been eaten. This NFT also gives you access to unique deals on your next cake and companies this fancy bakery has partnered with. We've even come up with some possibilities with designer and luxury brands too. If some people really want to show off their purchases, which they do of course, they would share their wallet ID on a social platform they use to make the purchases and become a verified purchaser of the product, showing off the verified purchases of their NFTs publicly. This is a real-world use case for NFTs that will make mainstream adoption even easier. Although it's still early, we see the potential in Solana Pay. And if you have a business that would like to get involved in using the payment system, they have information for businesses on their website at solanapay.com. Now let's talk about the Solana drama. The great growth of any ecosystem is always met with its fair share of criticism, and Solana is no stranger to that. Due to much speculation of this ETH killer, on Twitter, a heated exchange between early Solana investor, FTX founder, and crypto billionaire Sam Bankman-Fried and a prominent Twitter trader, CoinMamba, brought all eyes and bets directly on Solana. The exchange of the value of Solana ended with a now historic tweet from Sam, ending with Sam replying, "I'll buy as much SOL as you have right now at $3. Sell me what you want, then go." Going almost 90x from that point made Sam and Solana put their money where their tweets were. Despite the monetary success, Solana has also been known as a VC coin, or venture capitalist coin, as it received most of its funding from large venture capitalists. Instead of receiving stocks, investors receive coins before the public got access. The investors are invested heavily into the hopes that the coin increases in value. Investments are an important part of crypto and have allowed many projects to be creative. But there are red flags that come into question by the crypto community. One of these red flags is the initial coin allocation. Did the initial investors receive all of the coins before the launch? This affects the core ethos of crypto being decentralized, as a small few investors control the future of a coin. In 2021, Ryan Watkins, a crypto analyst for Messari, posted a research diagram showing the initial allocations for 15 different blockchains. Blockchains such as Ethereum had 20% allocation for investors, team, and foundation, and 80% for the public sale, while Solana allocated over 61% for investors, team, and foundation, saving around 40% for ecosystem funds and only a tiny sliver for public sale. This meant that the majority, 95% of Solana, was in control of a small group of people. They had an additional private sale of $314 million in June of 2021 to a group of over a dozen investing firms, including Alameda Research and Polychain Capital. In response, one of the founders had said this: "If there was a way to get a layer 1 built from scratch with less VC funding, less allocation from insiders, and more allocation from the public, we would have done it. The market was very different back then, and we barely scraped by." Solana came under the scanner again in November of 2021 as early investors into the project, venture capitalist Chamath and crew of the All-in-One podcast, had joked about trying to sell Solana in a over-the-counter sale. An over-the-counter sale, or OTC trade, is one that is done more privately than buying and selling on an exchange. This allows for those who have invested millions of dollars to sell their coins without having to sell them on an open exchange. This keeps the price on the open market from falling drastically in one sale, as buyers cannot absorb the sell pressure. It's like holding up a bucket trying to catch a waterfall. The timing of that podcast episode also did not fare well for their credibility, as it just had happened a few days before Solana reached an all-time high near $260 and thus began starting its decline. Early investors taking profit has always meant a price drop in any blockchain's token. But with the Solana's community continued effort to innovate, recovery may be quicker, and this may be behind them sooner than we think. Now let's talk about Solana's outages. Being an ambitious new technology, with its sights set on thousands of transactions per second, Solana has become plagued by network outages. The ethos of Silicon Valley's move fast, break things may work well in certain products, but when it comes to the safety and security needed in blockchain technology, it isn't always received well by the crypto community. As Solana is still a new technology, it does not yet get the decentralization effects that the more established, long-standing chains like Ethereum and Bitcoin benefit from. This includes having many thousands more validators securing the network and a more even amount of staked Solana spread out through the validators. In the most recent outage back in May of 2022, it was noted by CJ Remus that there was an almost instant 30% jump in the active staked amount of SOL used to begin the restart. As validators are needed to come to an agreement to make the necessary decisions, think of staked SOL like votes. and the more votes a decision has, the more quickly you can come to that agreement. Having 30% come almost instantly, Chris suggested that it may have either been a strong coordination among whales, aka large holders of SOL, or a single operator controlling 30% stake in SOL. This goes in the temporary negative column for the decentralization of Solana. Could you imagine owning 30% of voting power in your country? Another interesting problem that Solana currently has is that cheap transaction fees make it easy to spam the network and create a problem. So a win for cheap transactions, but also a win for the spam bots. In time and learning, it will be interesting to see how Solana navigates these issues. Now, in conclusion, Solana has had an explosive year in 2021 and continues to innovate. Solana currently sits at around 2,000 transactions per second, which is very impressive for a blockchain, but still far away from the proposed hundreds of thousands per second. But we wouldn't want to stand in their way of these ambitions. The early red flags of early investor allocation and lack of decentralization in favor of speed has received criticisms from the crypto community. Now still, with its innovations, cheap transaction fees, and sub-second transaction time, Solana has attracted billions of dollars into its networks. The creative NFT artists and builders on Solana are a very motivated and bright bunch and can continue to carry Solana into a more decentralized world with time. If you're looking for a place to start, we recommend checking out the Solana NFT art on magicden.io and OpenSea. If your hardware wallet doesn't have support yet, we recommend using the Brave web browser extension and downloading the Phantom wallet. Its interface is intuitive and clear, and it provides an easy connection into the Solana blockchain.